Have you ever wondered what the stock market really is? Maybe you've heard about Warren Buffett's billions, or perhaps you've seen others treat the stock market like a casino, betting it all, only to lose it. So how do you get it right? Well, by the end of this video, you'll know exactly how the stock market works and how you can start investing with as little as $50 or $100. Sounds good, right? Grab your notebook. Feel free to pause and rewind if needed. And don't worry, this video is long enough for you to watch in parts. Ready? Let's dive in. Why invest in the stock market? Let's start with the basics. You've probably heard of the S&P 500. It's a stock market index that tracks the top 500 companies in the US. It's considered one of the best representations of the market. And here's an interesting fact. The S&P 500 has delivered an average annual return of about 8 to 10% over the long term. That's a pretty solid track record. By investing in the S&P 500, you're investing in a proven strategy to build wealth over time, without having to pick individual stocks. Now, stocks have historically outperformed other assets like treasury bonds, gold, and even real estate. This is why many high-net-worth individuals focus their investments on stocks. They are one of the best wealth-building assets. Keeping your money in a savings account? Well, that's not the best strategy. With interest rates near 0.1%, your money isn't growing. Investing, on the other hand, takes advantage of compound interest, where your money earns money, and over time, that can lead to significant wealth, overcoming inflation and maximizing gains. Let's talk about inflation. You've probably noticed that the cost of goods and services goes up over time. Take postage stamps. Back in 1971, they cost just 8 cents. Today, 73 cents. And this rising cost? It's called inflation, and it erodes your purchasing power. So the question is, how can you outpace it? By investing. Let's say you make $70,000 a year and save $5,000. If you invest just $11,000 each month and earn an average 8% return, in 30 years you could accumulate over $1.5 million. That's the power of consistent investing and compound interest. Of course, the stock market isn't without its ups and downs. It's normal to see years with losses, but if you stay the course, the long-term growth tends to outweigh short-term setbacks. Understanding what the stock market is seen. Post with a simple graphic showing the stock market as a marketplace. So what exactly is the stock market? It's a digital marketplace where you buy and sell ownership shares in companies. Share prices go up and down based on factors like supply and demand, the company's performance, and the overall economy. Companies sell shares to raise money for growth, usually through something called an initial public offering, or IPO. By buying shares, you're essentially betting on the company's future growth. Key stock market terminology. Host with a board showing key terms like bull market, bear market, market cap, dividends. Now, let's run through a few key terms. Bull market means prices are rising, while bear market means they're falling. Market cap refers to a company's total value, and dividends are payments companies make to shareholders. You'll also hear terms like blue chip stocks. These are the stable, reliable companies. Then there are penny stocks, cheap but risky, and large cap stocks, which are established and less volatile. And when people talk about a frothy market, they mean it's overvalued. How to invest as a beginner host? With a chart comparing individual stocks versus index funds. As a beginner, you've got two main routes, individual stocks and index funds. Individual stocks can be exciting, but they're risky. Index funds, on the other hand, are less risky, more stable, and have historically returned around 8 to 10%. For long-term growth, index funds are a great choice. Another smart strategy is the three-fund portfolio: U.S. stocks, international stocks, and bonds. This gives you balance and diversification, which even professional investors struggle to beat. And if you're planning for retirement, consider target date funds. They automatically shift towards safer investments as you near retirement age. How to start investing: accounts and platforms. To get started, you'll need an investment account. You can go for a taxable brokerage account, or for retirement, an IRA or Roth IRA. I recommend looking into a Roth IRA for its tax-free growth. For beginners, platforms like M1 Finance, Fidelity, and Robinhood are great. They're easy to use, and they give you access to the stock market and a variety of account types. Researching stocks. When it comes to researching stocks, there are two main types of analysis: fundamental and technical. As a beginner, you'll want to focus on fundamental analysis, looking at a company's health, financials, and growth potential. Some key metrics to consider include revenue, net income, price-to-earnings ratio, price-to-sales ratio, and free cash flow. Tax implications of investing. Let's briefly touch on taxes. If you're investing through a taxable account, you'll pay taxes on gains. However, with a Roth IRA, your gains grow tax-free, which is a major advantage. One strategy for minimizing taxes is tax loss harvesting, where you sell losing investments to offset gains. Just remember, taxes shouldn't control your strategy, but being aware of them is important. To wrap it up, investing in the stock market is one of the best ways to build long-term wealth. Start small, follow the strategies we discussed, and you'll be on your way. Check out the resources and affiliate links in the description below. Don't forget to subscribe, watch more videos, and keep learning. See you next time.